Welcome back to Talk Tickers. For those of you who tune in regularly, you know our mission with this deep dive format. We look at corporate earnings calls, we break down the Wall Street jargon into plain language, and we give you a data-forward, opinionated look at what's really happening.
Exactly. And today we are digging into a fascinating situation with Electro Optic Systems.
Right. That's trading as EOPSF or on the ASX as EOS. We are specifically looking at their May 17th, 2026 capital raising call and the accompanying investor presentation.
Yeah, and this one is, well, it's a wild ride. The headline is that EOS is asking for 150 million Australian dollars in a capital raise.
Which, immediately sounds off alarm bells for retail investors.
Oh, absolutely.
Yeah.
The instant you hear capital raise, you think, share dilution.
Right. You think, are they burning cash? Are they desperate to keep the lights on?
Yeah, but our goal today is to figure out if this is actually a red flag, or if it's the necessary fuel for a massive battle-tested growth phase.
So let's start with the headline numbers, because the context here is just bizarre. When a company acquires another business, the standard operating procedure is usually highly predictable, right?
They vary by the book, the ink dries, you send out a press release talking about, synergies.
Yeah, synergies, exactly. And then everyone settles in for a long, agonizingly slow multi-year integration. You lock in the price, you set a conservative performance bonus for the founders, and you just hope the asset slowly appreciates.
Which is exactly what EOS thought they were doing earlier this year.
Right. So they acquired this defense tech company called Moz, and they set this ambitious performance bonus and earnout cap at 10 million euros. But that was only if Moz somehow managed to hit 500 million euros in orders.
And that was viewed as this sort of aspirational blue sky scenario.
Totally. Maybe in 5 years we'll hit that. Huh. But the ink on that deal was barely dry in January. By May, management basically had to tear up the contract.
Yeah, they raised that earnout cap by a staggering 1,400%.
From 10 million to 140 million euros.
Exactly. Based on a new target of 700 million euros in orders.
Which is just a phenomenal deviation from standard M&A practices.
It really is. I mean, you almost never see an acquiring board willingly reopen a closed deal to offer the sellers a substantially higher payout ceiling.
Unless, of course, the fundamental market reality of the asset has violently shifted.
Right. To shatter a 5-year projection in 4 months, you need a massive external catalyst.
And in the defense sector, that catalyst invariably means war.
Yeah, unfortunately, that's the reality.
So this brings us to the crux of the situation for you, the listener. We have a company whose unconditional order book has violently accelerated to 726 million Australian dollars.
It's just exploding.
But simultaneously, they're executing this $150 million capital raise.
Through a placement of about 19 million shares, yeah.
Plus a non-underwritten share purchase plan for the retail investors.
Right. And, the mechanics there are designed to bring in institutional capital quickly while trying to let the retail base avoid total dilution.
But I want to push back on the optics of this earnout restructuring first. Let's translate this into plain language.
Okay, let's hear.
It's like a salesperson's commission cap being raised by 1,400%. You only do that if the product is suddenly selling itself, right?
Yeah, it's practically flying off the shelves.
But if I'm the CEO and I bought Moz in January with a 10 million euro cap, my instinct is to hold the sellers to the original contract.
Sure. Legally, you could do that.
Right. I bought the asset. I take the windfall. Why willingly surrender up to 140 million euros in future payouts? From the outside, it feels like terrible capital allocation.
Well, from a rigid contractual standpoint, yeah, you could argue that. But you have to remember, in the defense technology sector, especially with software-heavy architectures like Moz, you aren't buying a factory.
Okay, so what are you buying?
You're acquiring human capital. You are buying the specific engineers, the relationships with defense ministers, the institutional knowledge.
Ah, right. The people who actually know how to iterate the software in real time?
Exactly. You need them to respond to live combat data. If the founders realize they just sold a multi-billion-dollar asset for pennies because of an unforeseen war, their motivation just plummets.
They might just walk away the moment their lockup period expires.
They absolutely would. So by voluntarily lifting the cap, EOS is effectively buying retention and aggressive execution.
Okay, that reframes it entirely. It's an alignment of incentives. But that still leaves the glaring question of the $150 million capital raise.
The big red flag for the tickers, yeah.
Right. If the asset is this valuable and the order book is at $726 million, why do they need a massive cash injection right now?
So to understand this, you have to look at the macroeconomics of international defense procurement. These aren't standard B2B transactions.
It's not a net 30 invoice.
Not at all. When a sovereign nation signs a defense contract worth hundreds of millions of dollars, they demand extraordinary financial insurance.
They need absolute certainty that you won't go bankrupt halfway through building the system.
Precisely. And this insurance comes in the form of bank guarantees.
Right, collateral. It's like if you're building a house, you don't give the contractor the whole budget up front. You pay in installments.
Yeah, but in defense, the stakes are national security. The government needs a guarantee that if you fail, they get their money back instantly.
And those guarantees are pretty punitive to a balance sheet, aren't they?
Oh, they are aggressively punitive. The investor presentation detailed a prime example of this dynamic.
Let's hear the data.
So the MOS division recently secured a new contract worth over 160 million Australian dollars.
Okay, great news.
But the foreign government initially demanded a bank guarantee of 100 million Australian dollars to be held on lockup for 2 years.
Wait, let me make sure I'm grasping the math on that. To secure 160 million in future revenue, EOS would have to take 100 million of their own cash or a massive credit facility and just park it in an untouchable bank account for 24 months.
That is exactly right.
That is an absurd level of capital intensity. It basically paralyzes the company. You can't use that money for R&D, you can't hire engineers, you can't use it for the next contract.
It creates a massive growth trap. A mid-cap defense contractor could win $1 billion in orders. But if every order requires a 60% cash collateralization rate, they will literally bankrupt themselves trying to fulfill the demand.
It's a death spiral.
A very common one for companies trying to scale up to the prime level.
So if a $100 million lockup is a death sentence, how do they resolve it? Because they obviously didn't walk away from the deal.
They leverage their newfound market power. Because the MOS tech is in such hyper demand right now, EOS management was actually able to dictate terms to a sovereign buyer.
Wow, you don't hear that very often.
No, you really don't. They pushed back on the 2-year guarantee and successfully negotiated it down to a short-term working capital requirement of just $40 million.
Structured over, what, the first few months?
Yeah, the first 1 to 3 months of the contract.
That is a staggering reduction in friction. Dropping the collateral demand by $60 million fundamentally changes the profitability.
But it still requires $40 million of liquid capital to initiate.
Which brings us directly to the $150 million capital raise.
Exactly. To walk into a negotiation and reject a defense ministry's standard collateral demands, you have to be negotiating from an impenetrable position of financial strength.
Your balance sheet has to be bulletproof.
Right. So the raise is not for keeping the lights on, it's strategic armor.
It allows them to self-fund those $40 million working capital requirements without tapping into restrictive debt covenants.
And having that liquid balance sheet lowers the collateral ratios that institutional banks will demand for any future guarantees they do need.
It's a virtuous cycle. It totally transforms the narrative from we need cash to survive to we need cash to dictate terms.
Which is a very bullish signal for retail investors to pick up on.
Absolutely. So the data strongly suggests this is offensive posturing, but to justify this level of aggressive structuring, the underlying technology has to be irreplaceable.
It does.
So let's dig into the story behind the numbers. The catalyst between the January acquisition and the May restructuring was the sudden escalation of conflict in the Middle East. Right?
Yeah, it took the MOS technology out of the theoretical realm and threw it right into a live fire environment.
Because the defense market is notoriously skeptical.
Oh, incredibly skeptical. You can publish thousands of pages of simulated data, but until it's tested in actual combat, it's just theory.
So what is the core tech they acquired?
It's called the NIDAR command and control system.
Okay, and prior to the escalation, EOS had already deployed dozens of these NIDAR systems in the Middle East, mostly to protect critical infrastructure.
Right. The presentation mentions royal palaces, military bases, massive energy facilities.
Like Saudi Aramco type sites.
Exactly.
Now, the phrase command and control system gets thrown around a lot as a buzzword. For you listening, to understand why this is driving a $700 million order book, We have to look at what it actually does.
Yeah, because it isn't a weapon in the traditional sense.
Right. It doesn't fire bullets. It doesn't launch missiles. It's essentially an artificial intelligence brain that manages the airspace.
That's a perfect way to describe it. It's an incredibly sophisticated software architecture built on sensor fusion.
Sensor fusion, meaning it takes data from everything.
Yeah. Think about a modern threat environment. A single facility might be protected by a dozen different radars, infrared cameras, acoustic sensors, and electronic warfare antennas.
And if a human operator has to monitor 12 different screens to figure out if a blip is a flock of birds or an incoming kamikaze drone,
the reaction time is just way too slow. The cognitive load is too high.
especially considering the specific threats, NIDAR has been defeating Shahed-style drones.
Right.
And these aren't massive fighter jets moving at Mach 2 at 30,000 feet. These are relatively slow, low-flying, loitering munitions.
They have tiny radar cross-sections. They blend in with ground clutter.
So if you rely on a single traditional radar, a swarm of these drones just slips right through the net.
But NIDAR solves that. It takes the raw data from every single sensor and uses AI to fuse it into a cohesive three-dimensional map of the airspace.
In milliseconds.
Exactly. It cross-references an anomalous radar return with an acoustic signature and an infrared heat bloom. It autonomously identifies the threat, calculates the optimal interception vector, and then automatically assigns the right weapon system to neutralize it.
And what the market saw in early 2026 was this system performing flawlessly under extreme duress.
Yeah, management stated NIDAR was actively used to defeat hundreds of Shaheen-style drones and dozens of incoming rockets and missiles in live combat.
You literally cannot buy marketing that powerful.
You can't. When defense ministers see a system successfully repel a massive drone swarm aimed at an oil refinery, the procurement cycle accelerates exponentially.
The CEO noted that practically every country in the Middle East has now initiated discussions with EOS.
The demand profile just completely shifted from, let's evaluate this over 3 years, to, we need this installed next month.
Which sets up this really fascinating market dynamic. It's a total David versus Goliath scenario.
It really is.
Because the defense industry is dominated by prime contractors. These massive conglomerates generating $15 to $25 billion in annual revenue.
With entrenched political relationships and massive lobbying power.
So when a huge contract comes up, like a tender for a nationwide command and control system, you assume one of the giants wins by default.
Historically, yes. Sovereign governments usually default to the perceived safety of a legacy prime.
But the presentation revealed that Moz, this relatively small software division of EOS, went head-to-head against two of these multi-billion-dollar European primes for a nationwide tender.
And they won.
They won. How does a company with a fraction of the resources defeat these massive contractors?
It comes down to the specific nature of the drone threat. The legacy primes are built for 20th century wars. They build exquisite, multi-million-dollar missile systems like the Patriot.
But using a Patriot battery to fight a swarm of $20,000 Shahed drones is economic suicide.
Exactly. The cost per kill ratio is totally unsustainable. You'll run out of expensive interceptors long before the enemy runs out of cheap drones.
So the market has violently shifted toward specialized counter-UAS solutions?
Yeah, unmanned aerial systems. NIDAR represents a cost-effective, tailor-made architecture for this new paradigm.
And crucially, NIDAR just proved it works in live combat.
That's the ultimate differentiator. However, we do have to look at the risks here. Winning a nationwide contract introduces massive execution risk.
Right. It's one thing to design brilliant software. It's another to deploy it across an entire nation.
And this is where we need to critically analyze the global supply chain. The defense industry is facing severe bottlenecks in hardware manufacturing right now.
Oh, massive shortages. Radars, optical sensors, microchips, they're all back-ordered globally. So here's my pushback on this nationwide win. If you win a contract to build a nationwide network, you need hundreds of radars to feed data into the NIDAR software.
You do.
If the waiting list for a high-end radar from a major supplier is 2 years long, doesn't that completely stall the rollout of the EOS system? I mean, a software brain is useless without the hardware eyes and ears.
It would be a fatal flaw if NIDAR was a closed ecosystem. But the architecture of the software provides a massive asymmetric advantage here.
How so?
NIDAR is fundamentally hardware agnostic. The CEO spent a lot of time explaining this modularity. To date, it's been successfully integrated with over 160 different types of third-party sensors and effectors.
Over 160 integrations. That implies a level of open architecture flexibility that is very rare in military tech.
Extremely rare. Usually, contractors build closed loops. If you buy their software, you have to buy their proprietary radars and missiles.
And that closed-loop model is exactly what creates the supply chain bottlenecks.
Precisely. Because NIDAR is hardware agnostic, EOS isn't reliant on any single manufacturer. If a client is ready to deploy, and supplier A is back-ordered for 18 months, EOS just tells them to buy from supplier B, C, or D.
Because the software already knows how to talk to those alternative systems.
Exactly. It drastically mitigates the hardware supply chain risk.
It also requires remarkably low capital expenditure from EOS to scale up. They don't need to build massive new factories to fulfill this nationwide contract.
Right, they don't have to pour concrete or buy assembly line robotics.
They just deploy software engineers to adapt the code to whatever sensor suite the client procured. The heavy lifting is computational, not industrial.
That's the beauty of applying the software as a service model to kinetic defense.
Now, they do manufacture some physical effectors, right, like kinetic gun systems.
Yes, primarily the Slinger system, which recently secured a $60 million order. But even there, they have built-in redundancy. Management confirmed they have the capacity to produce over 300 of these remote weapon stations annually on a single shift.
And they can double that to 600 just by adding a second shift.
Yeah, they aren't facing a near-term production ceiling on their proprietary hardware.
Okay, so we've established the demand is real, the tech is tested, and the supply chain strategy is resilient. Now let's translate this into financial projections.
The management guidance portion of the call.
Right, because a $726 million order book is a great headline, but for you as an investor, a backlog is meaningless if it takes a decade to convert to cash.
Absolutely. But the conversion timeline they laid out is exceptionally aggressive. Management projects that a massive 60 to 80% of that combined order book will flow directly into recognized revenue through the remainder of 2026 and throughout 2027.
That's not a slow trickle. That is a fire hose of capital hitting the balance sheet over the next 18 months.
It implies these client nations aren't buying systems for strategic reserves. They are deploying them actively right now.
And the urgency is obvious in the contract structures. You mentioned the revenue recognition model for that $160 million deal earlier.
Yeah, a full 70% of that revenue is tied to the initial setup, integration, and delivery phase, which happens over a very compressed 12 to 15-month timeline.
And what about the remaining 30%? Because in software, the recurring revenue tail is where the margins are usually highest.
That remaining 30% is spread out over the next 3 to 4 years for maintenance, optimization, and critical updates.
And that's highly lucrative. As the AI learns from new drone tactics, those updates become indispensable.
It creates profound customer lock-in and a highly predictable stream of high-margin recurring revenue.
But the guidance wasn't just about signed orders. They gave us a window into their short-term pipeline, highlighting 2 massive deals in advanced negotiations.
The first one is the logical next step of that tender they won against the primes. It's phase 1 of the nationwide command and control system.
And management stated they are the exclusive partner negotiating this contract.
Right. And they value phase 1 alone at over $300 million US.
Let's make sure we highlight that distinction. $300 million US converts to roughly 450 million Australian dollars.
That single phase 1 contract represents more than half the value of their entire existing order book.
And it's only phase 1. The CEO made it clear the full scope of the multi-year program is expected to scale into the multi-billion-dollar range.
Securing phase 1 entrenches EOS as the foundational architecture for that nation's defense for decades.
And the second deal in the pipeline.
It's a phase 2 contract for an existing Middle Eastern client, valued at over $100 million US.
Which indicates successful land and expand execution.
Exactly. A client bought an initial installation, saw it perform in combat, and is now rapidly expanding coverage. Management actually anticipates signing this one even before the larger nationwide contract.
So when you aggregate all of this, a $726 million backlog converting rapidly, plus over $400 million US in near-term negotiations, the logic of the $150 million capital raise becomes undeniable.
Completely undeniable. They need an ironclad balance sheet today so they can execute these $500 million negotiations tomorrow.
Without banks dictating crippling terms.
Exactly. It's the ultimate display of capital agility.
But, the financial modeling really only tells half the story of this presentation because the call took a very dramatic turn into R&D timelines that honestly sound like science fiction.
Oh, the directed energy weapons portfolio.
Yes. We've talked a lot about software brains and kinetic guns, but kinetic weapons have hard physical limits. You eventually run out of bullets.
And the logistics of supplying ammo to remote bases is incredibly complex.
Which is why the holy grail of air defense has always been directed energy. High-energy laser weapons.
Because lasers solve the cost per kill equation permanently. Once installed, the cost to fire a shot is basically just the cost of the diesel to run the generator.
It's measured in pennies.
Right. And EOS has been developing a 100 kilowatt high-energy laser system. The updates on the call suggest a radical acceleration of that timeline.
Because building a laser in a lab is one thing, but building one that works in a dusty, high-temp combat zone is a monumental engineering challenge. You have thermal management, atmospheric distortion.
Which is usually why defense timelines for directed energy slide backwards. But EOS announced the exact opposite.
Their launch customer is the government of the Netherlands, right?
Yeah. Following a critical design review in Singapore, the Dutch client was apparently so satisfied that the delivery schedule was pulled forward by a full 6 months.
In defense procurement, pulling a bleeding-edge tech timeline forward is practically unheard of.
It's a massive vote of confidence from a NATO ally. It means EOS is on track to deliver the system in 2027.
And the implications of that 2027 date are profound. It positions the Dutch system to potentially be the first fully operational, fielded 100-kilowatt laser weapon of its kind anywhere.
Granting EOS an immense first-mover advantage.
And the commercial structure of the Dutch relationship is highly unusual, too. Usually, a military buys a prototype, tests it for 3 years, and then orders serial production.
But the urgency has shattered that cycle. The CEO revealed the Dutch client is prepared to place the order for the first full serial production lot prior to the final delivery of the initial system.
They're pre-ordering the fleet before the first car rolls off the line.
Providing EOS with significant unforecasted upside potential in the first half of next year.
And the interest isn't limited to Europe. Middle Eastern clients are demanding immediate access to these lasers.
But nobody on Earth currently has a warehouse full of combat lasers ready to ship.
So how is EOS capitalizing on that?
They plan to use a portion of the capital raise to construct a $10 to $20 million laser demonstrator unit out of their own pocket and permanently install it in the Middle East.
That is an aggressive, high-stakes sales tactic. They're building a multi-million-dollar prototype, putting it in a combat zone, and letting buyers watch it shoot down live threats.
The ultimate try before you buy.
If it succeeds, the order volume will be astronomical. But as staggering as that is, it pales in comparison to what they discuss next, the Space Control Division.
This was the most profound, long-term strategic shift outlined in the presentation, driven entirely by the security dynamics in Europe and the vulnerability of space assets.
When they started talking about fast-tracking mobile, ground-based anti-satellite weapons, my immediate reaction was, wait, are we launching missiles into orbit to blow up satellites?
Yeah, which leads directly to Kessler syndrome.
Right. A cascading chain reaction of high-speed shrapnel that traps humanity on Earth.
It's absolutely critical to make the technical distinction here. Wall Street and defense strategists view these systems very differently. EOS is emphatically not building kinetic anti-satellite missiles.
They aren't creating space debris.
No, they use directed energy, optimized for a completely different environment.
So how do they neutralize a satellite without blowing it up?
Optical interference. These are mobile ground-based systems designed to track adversary reconnaissance satellites in low Earth orbit, and then use a highly calibrated directed energy beam to dazzle or temporarily blind the optical sensors.
It's like shining a tremendously powerful laser pointer directly into a security camera lens. The camera isn't destroyed, but the image is totally washed out.
Precisely. It denies the adversary the ability to see troop movements or critical infrastructure preparations without triggering an international incident involving space shrapnel.
The level of precision required for that is unbelievable. You're tracking an object moving at 17,000 miles per hour, hundreds of miles up, hitting a target the size of a dinner plate through the atmosphere.
Which is why everyone assumed this tech was sequestered in superpower R&D budgets, slated for the 2030s or 2040s.
Even EOS had previously projected the commercial market wouldn't materialize until 2030 at the earliest.
But the timeline has radically contracted. The CDO stated there is a severe immediate demand for these ground-based systems, primarily from European and NATO nations.
Why the sudden, desperate need from NATO?
Survivability in a high-intensity conflict. If a nation builds a massive static anti-satellite facility, it becomes target number one on day one of a war.
An adversary just launches cruise missiles to wipe it out.
Exactly. European clients realize static defenses are obsolete. They need mobility. Systems that can be mounted on heavy trucks, deployed into a forest, execute a blinding mission, and relocate before the enemy can calculate the point of origin.
And EOS has the inside track on this.
The CEO made a staggering claim. These mobile, non-kinetic blinding systems are unique worldwide, and nobody else has this capability integrated into a deployable portfolio. They anticipate operating with a virtual monopoly in the non-U.S. market for the next several years.
Claiming a monopoly on non-kinetic space warfare for NATO allies is a massive statement to make to investors.
And they're backing it up with immediate capital deployment, allocating $10 to $30 million from this current raise to build fully integrated prototypes.
To take on a demonstration roadshow across Europe in the first half of next year.
They've already laid the groundwork, hosting the German Minister of Defense and European Space Force commanders in Australia recently.
We have covered an immense amount of ground today. We've dissected the explosive order book, the live combat validation of NIDAR, the hardware-agnostic strategy, the aggressive revenue conversion, and the transition of laser and space weapons from sci-fi to near-term deployment.
It's time to synthesize all of this data into a definitive verdict for the ticker watchers.
Right. So looking at the core question, is this $150 million capital raise a dilutive red flag or the fuel for explosive growth?
The data overwhelmingly supports a definitively bullish stance.
Yeah, I have to agree. The analysis leaves very little room for a bearish interpretation of the raise itself. This is not a distress signal.
It's a highly calculated, aggressive maneuver to optimize working capital. They have a $726 million order book and a $500 million near-term pipeline. If they execute with a weak balance sheet, they get crushed by restrictive bank guarantees.
By raising the capital from a position of strength, they gain the leverage to negotiate favorable terms and accelerate scaling without violating covenants.
They are trading a small amount of immediate equity dilution for total control over their balance sheet during a period of hypergrowth.
Because they hold the ultimate bargaining chip, proven capability. NIDAR isn't just a concept. It is the definitive, combat-proven counter-drone system available today.
Which grants them immense pricing power and credibility, allowing them to outmaneuver the legacy primes.
So for the retail investor listening, what are the specific, actionable metrics they should be monitoring?
The headline backlog is great, and the 60 to 80% conversion rate is vital for cash flow. But the true catalyst to watch is the execution of that $300 million phase one nationwide contract.
That's the crucial inflection point.
If management finalizes that deal and proves they can roll it out without falling victim to global supply chain delays, proving the software agnostic strategy works at scale, the revenue acceleration in 2027 will be historic.
It elevates them from a niche software provider to a tier one defense partner. The data strongly points to this capital raise acting as high-octane fuel for a uniquely positioned company.
Exactly right.
The landscape of global security is fundamentally rewiring itself. We hope this deep dive provided the exact data points you need to understand how Electro Optic Systems is navigating that shift. But as we sign off, there is a broader, forward-looking question that merits some deep consideration.
Yeah, regarding the rapid acceleration of the anti-satellite tech.
Right. EOS is moving the timeline for operational deployment of space warfare tech from the distant 2030s to an active European roadshow next year, driven entirely by sudden demand from NATO allies.
Which is just wild to think about.
The question you have to ask yourself as an investor is this. With this massive, unprecedented contraction in development timelines, are public markets completely underestimating how rapidly the domain of space warfare is transitioning from speculative science fiction into immediate, concrete, line-item defense budgeting?
Because if the future of orbital conflict is already being funded today, the companies building the foundational architectures are moving much, much faster than the broader market has realized.